Good afternoon, everybody. It's Wednesday, November 7th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is not the weekly economic and commentary. This is an off-cycle commentary based on the outcome of yesterday's presidential and congressional elections. As a reminder, you can follow me intra-week on LinkedIn, Herb Morgan, or on Twitter at Herb W. Morgan. This presentation has been prepared by me for use with you, whether you are an investor, consultant, financial advisor. But regardless, you're expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice. There's no tax advice, no recommendation for the purchase or sale of any security. Everything is purely for informational purposes. Well, let's start out with the quote from former President Barack Obama, who famously quipped, "Elections have consequences." And for months now, many of you have been asking me, what are you doing in the portfolios ahead of the elections? And I have deferred that question to say, well, I want to wait till after the election. And further, I want to wait till I know what the policy outcomes are likely to be. And I said the balance of power in Congress matters. Obviously, we know that Donald Trump will return as president. He's in the Republican Party. He definitely have secured the Senate in his favor with a sizable majority, and it now seems very likely that the House of Representatives will go with a slimmer majority, also go to the Republican Party. Anytime you have one-party control, that means the changes can be bigger. So in the Republican Party, there would be more towards the Republican economic values. If it were the Democratic Party, the policy changes would be more towards Democratic value. When we have a split government, we tend to have to find compromise and middle ground, and the changes tend to be smaller. So let's get into how we think this might impact GDP. GDP, gross domestic product, is the total monetary or market value of all the final goods and services produced by a country in a specific period of time. We use the calendar year. The formula for GDP is consumption. That's the things you and I do every day. We go to a ball game or a restaurant, buy new clothes, buy a car, whatever it is we do, that's consumption. It's the most crucial and critical part of the economy, and it's also the largest part of our economy. So the formula is consumption plus investment, that's the I, plus government spending, that's the G, plus the trade deficit or surplus. So plus exports minus imports. That's the formula for GDP. So if we dig a little deeper and ask what's likely to happen in both the short term and the longer term to each of the components of GDP based on what we now expect might be the policy outcome. Now keep in mind, electioneering policy promises are seldom enacted as made. There is a lot of sausage making that goes on. There's reality that sets in and the ability or the inability to get something done. But based on the fact that we did have one party sweep control of power, I think we can say definitively the economic policy of the country is going to move to the right. We don't know if it'll move to the right right after the president takes office, January 20th. Obviously, the Congress will be already 3 weeks of work. Theoretically, they could put something on his plate to sign, or will it take longer than that? Will the party stick together? Will somebody fracture and make a deal? Will members of the other party, Democratic Party, come on board for changes? Let's take a look at consumption. Right now, consumption is strong, the economy is strong, the consumer is strong, and jobs are plentiful. Well, if income taxes are proposed to be lowered in the new tax legislation that I assume we'll see in January or February, that's likely to lead to higher disposable income. Lower corporate taxes would also lead to less upward pricing pressure because it's an input cost of production. That's likely going to lead to increased consumer confidence and therefore increased consumption. Over the short term and the long term, I expect the contribution from the consumer, from consumption, to be good. Next, we move on to investment, otherwise known as capital expenditures or CapEx. Right? This is business spending on productive equipment designed to generate GDP and revenue and sales and profits for an extended period of time. Keep in mind that the Tax Cut and Jobs Act of 2017 is still in place, and it provided very strong incentives for companies to invest. That was scheduled to expire at the end of 2025. Most of the benefits were scheduled to expire at the end of 2025. I think we can now say definitively that they won't be allowed to expire. They might be extended, they might be modified. But either way, the incentive for capital investment is absolutely going to improve, and it will inspire more investment in growth in the overall economy. Now, on the short-term basis, if companies know of new legislation that's coming that might make an even greater incentive for capital expenditures, they might delay investments in the short term as they wait for the new legislation to take effect. If that's the case, then the short-term implications to GDP on the investment side could be negative. But we do expect strong long-term contributions to GDP coming from the I component of the GDP formula. Now we move into the government spending part of GDP. There has been talk, a lot of talk in the last couple of weeks, because the market view is that a Trump victory would lead to bigger deficits, more government spending, higher interest rates, and higher inflation. That was the narrative. But the campaign came out in the last couple of weeks, along with several surrogates, a couple of spokesmen, most notably Elon Musk and Cantor Fitzgerald's chairman, Howard Lutnick, and they talked about something called DOGE, Department of Government Efficiency. Theoretically, this would sharply reduce deficits, and a united government, meaning one party, would likely pass such radical austerity measures or fiscal reform. When asked what would be the short-term impact, Elon Musk said, "We have to reduce spending to live within our means, and that necessarily involves some temporary hardship, but it will ensure long-term prosperity." So I would say it's more likely than not that in the short run, if they are to do this, whether or not they'll actually cut $2 trillion is yet to be seen, but that is a subtraction from GDP. But it's also an investment in GDP out into the future. So I am going to categorize that as a negative short term. There was some talk about this from the president-elect last week, but long-term strong contributions to GDP as the investments in the private sector pay off and begin to fill the GDP gap that was left by those fiscal austerity measures that must be put in place. So I think the president-elect was clear. We'll see how the policy actually follows up, but I know that the surrogates and the spokespeople were very clear that any country, this is not a unilateral implementation of tariffs. Any country that does not have trade barriers or tariffs on our goods and services, or who locates the manufacturing capacity for their companies in our country, they would not be hit with tariffs. Still others will. So in order to avoid tariffs, foreign countries must accept U.S. goods without barriers. If we do have increased tariff activity or trade barrier activity, maybe we also have reduced barriers to trade for our goods going overseas because of the threat of import barriers and tariffs here. I would think that the net short-term contribution to GDP here is positive, as is the long-term contribution to GDP. Then we take imports. Imports are a subtraction from GDP. Narrowing a trade deficit is a boost to GDP. So, if because of higher prices in imports, consumers and businesses choose to substitute domestically produced goods, it will have a double positive effect on GDP. First, we'll be consuming domestically produced goods and services. Second, we won't be importing foreign produced, which are a subtraction from GDP. So what we really are learning is that if these things are implemented as sort of advertised in the campaign season, then I think it is more likely than not that we do have a little short-term bumpy road, primarily because of the austerity measures that will need to be put in place. Why does this need to take place? Well, the United States has outstanding debt as a percentage of its gross domestic product at about 132% of GDP. That puts it among the most indebted nations in the world. Countries like Japan, Italy, and Greece, Portugal's not there. Japan, Italy, and Greece, high debt to GDP, very, very low growth rates. And this is our chairman. Welcome to Doge. We will rip the waste out of the $6.5 trillion budget. Our goal, balance the budget of the U.S. So this was an election promise or an election prediction, I guess. Now we'll wait and see how much of that takes place. Needless to say, though, with control of both houses of Congress, the likelihood of getting some or part or all of this done is certainly higher. But why does it even matter? Well, the U.S. holds a unique position in the world. We have this thing called the reserve currency status. The U.S. has been allowed to run perpetual fiscal deficits averaging about 3.5% of GDP since the end of World War II and for the past 50 years. Since 2020, however, since COVID, those deficits have averaged closer to 9% of GDP. Many economists believe that that number is too high and it's too risky because every year's deficit piles on to the existing debt, and that got us to that 137% of GDP debt level, which is very, very dangerous. It means we don't have the dry powder to Keynesian spend our way out of a recession or to manage the financial impact of a war. God forbid we should get into a war. So this status, which came about after World War II as the world's reserve currency, and our trade deficit, we send money overseas in exchange for goods. These overseas entities have our cash. The only place they can really put that is to buy U.S. Treasury bonds. That finances the deficit. So because of this, some people in government believe that an 8% perpetual deficit is okay. Others believe it should be 3%, and others believe the budget should be balanced. So what do we expect in the markets? This is the thing we want to get to. What can we expect in our portfolios? Well, first and foremost, I think the markets, which have recently run to new highs and hit new all-time highs again today on the euphoria surrounding the election results as from a pro-growth, pro-market candidate, but have sent the price of stocks so high relative to their earnings that the earnings yield on the S&P 500, that's the inverse of the price-earnings ratio. Flip it over, it's earnings divided by price. That's about 3.8%. Well, when we value stocks, we say, okay, what does it earn? The earnings is 3.8%. What's my alternative? Well, I could buy a U.S. Treasury bond at 10 years. That's guaranteed and it's risk-free. That's 4.4%. So it's rare that you get paid. You see the blue line above the orange line. It's quite rare that you get paid more for no risk than you do for taking risk. By this measure and this measure alone, the stock market is fairly valued, if not overvalued. This is why in the last few weeks I've been telling people it's a very good time to reassess your portfolio risk and portfolio allocation. You're closer to retirement than you were 5 years ago. So we take that, we go a little bit further, and we say, well, are bonds therefore just undervalued and they're going to rally up and get that yield way down here where it should be? Well, maybe not. Or is the stock market going to earn its way into this high PE multiple because of things like artificial intelligence, economies of scale delivered by productivity of technology? Maybe. We also know that we're still fighting inflation. Maybe this rise in yields is due to inflation. Maybe it's also due to a market that's anticipating more deficit and more government spending, which is the opposite of what the Doge and the president-elect are talking about. This graph, this blue line, let's talk about this. This is the break-even rate for inflation based on the U.S. 10-year Treasury. And then the yield on the 10-year Treasury above that represents a premium. You should get paid to own it in excess of inflation. And it's a pretty sizable premium. So what this says is, at least relative to stocks and relative to inflation expectations, the bond market's fairly undervalued. So we'll think about that. So what are we doing? What's our view? In the short term, I do have concerns about the valuation of the equity markets. I see the economy still strong. I see the job market, the labor market, the consumer still strong. I see capital investment, the investment component, still strong. I favor the U.S. now more than ever over international on all the tariff concerns. But I think there could be an initial adjustment if we move forward with these austerity measures. And by the way, I think we should for a long-term perspective. Then I think we could get a short-term adjustment in the equity markets. Bonds, on the other hand, very undervalued versus stocks. Expect normalized real returns and a modest premium over inflation. If we do get the spending and the deficit reduced, that will be disinflationary. On the other hand, there are a lot of pundits out there that say, no, they didn't really mean that. They're going to deficit spend more than ever, and that's going to drive inflation and interest rates even higher. And in alternative investments, not much of a change here. Although we own a merger arbitrage vehicle for our alternative weighting, and there's been some concern at the FTC and the willingness to get deals approved in a timely manner and get through. So it's likely that in the new administration, we'll see an FTC director that's more amenable to M&A overall. Anyway, hope that helps everybody. Thanks. I'll be back to you again on Monday. Don't forget, you can find us on the YouTube, Slaying Bulls and Bears, or on any of the different podcast formats. Thanks, and have a great day.